It's Sebastian here from Wealth Depot. Thank you for joining our age pension strategy video. In today's session, I wish to summarise changes to the age pension asset test, which will take effect from 1 January 2017. The new rules will have significant impact on your age pension entitlements if you have high asset values and are assessed under the asset test. So what are the changes? From 1 January 2017, if you own a home, the new asset thresholds will allow you to hold assessable assets up to $250,000 for singles and $375,000 for couples, without any impact on your full pension entitlements. The thresholds for non-homeowners also increased to $375,000 for singles and $575,000 for couples. It is estimated that around 50,000 Aussies are expected to be better off under the government's changes and receive the full pension. There is a downside to the changes though. Couple homeowners will lose their pension when their combined assets reach $816,000 in value. Single homeowners will lose their entitlement when they have more than $542,000 in assets. Another negative change, which will hurt pensioners the most, is the increase in the taper rate from $1.50 to $3. This rate indicates how much your age pension entitlements will reduce for every $1,000 above the asset test free area. So let's look at an example to explore the impacts of the new changes. In our first case study today, Ingrid, a single homeowner, has total assessable assets of $375,000. Under the current scenario, she will be entitled to $617.60 of age pension entitlement per fortnight. However, with the taper rate doubling from 1 January 2017, Ingrid's age pension entitlement will drop to $516 per fortnight. This example indicates that if you have total asset values above the new lower asset test threshold, you will experience a significant drop in your age pension. In light of the new asset test rules, some strategies may be put in place to increase your age pension entitlement, as listed on this slide. It is important to note that these strategies are not without risk, which we will briefly mention at the end of this presentation. As a homeowner, when you apply for income support, the value of your principal home is not counted towards the asset test, regardless of its value. Spending money on renovating a home can increase your property value, reduce the amount of assessable assets by the amount spent, and potentially reduce the amount of income counted under the income test. However, it is important to be aware that your liquidity will reduce by the amount spent on renovations. Therefore, before adopting this strategy, you have to make sure that you have sufficient cash to cover your daily and emergency needs. The second strategy is gifting. Gifting is when you or your partner give away assets or transfer them for less than their market value. It is possible to give assets valued up to $10,000 per financial year and $30,000 across a 5-year rolling period before there is any impact on your Social Security entitlements. If you exceed this limit, the excess amount will be assessed as deprived amount for 5 years from the date of gift and will be subject to the income deeming provisions. A drawback of this strategy is that due to the low gifting threshold permitted, the impact on your age pension entitlements may not be significant, especially when you have high asset values. In addition, once the assets have been gifted, you will lose control and use of those funds. Funeral bonds is another key to reduce your asset. It is a managed investment that earns interest, which can be used to cover your funeral expenses. The Department of Human Resources will not include the value of up to 2 bonds when assessing your assets, provided that you do not also have prepaid funeral expenses and the amount invested in the bond does not exceed the funeral bond allowable limit. The current funeral bond limit is $12,500, which is indexed on 1 July each year. For a member of a couple, they are able to invest up to the threshold each. However, if the amount is invested in joint names, the joint investment is subject to the $12,500 threshold. A final strategy to help boost your age pension entitlement is to use lifetime or term annuities. An annuity pays you a guaranteed income for a defined period of time. You can choose how long you want the payments to last, for example, a lifetime or a fixed number of years. The purchase price of the annuities is reduced by an amount equal to the deductible amount. The deductible amount is the amount of each regular payment that is considered to represent the return of your initial capital investment. The deductible amount is dependent on whether your annuity is a term annuity or a lifetime annuity. But generally speaking, for a term annuity, the annual deductible amount equals to your purchase price divided by the term of the annuity. For a lifetime annuity, your annual deductible amount equals the purchase price divided by your life expectancy. So referring back to Ingrid's case, assuming Ingrid decides to reduce her assessable assets prior to 1 January 2017, she spent $50,000 to renovate her house. She gifted $10,000 to her daughter. She purchased a funeral bond with a value of $10,000, and she also buys a 10-year annuity with a zero residual capital value for a price of $80,000. So now Ingrid's total assessable assets have dropped from $375,000 to $305,000 in year 1, which means her age pension retirement has increased from $516 per fortnight to $726 per fortnight. There are certain key considerations when adopting strategies to reduce your assessable assets. First, as your asset values drop, you may be assessed under the income test. A Centrelink will select the test, which results in a lower age pension entitlement. Secondly, the most significant risk is that you spend more today to reduce your assessable assets. You may face longevity risk as your assets are insufficient to support you in the future. In the case study depicted in the graph, Anne and Barbara both have $450,000 in their superannuation. Anne increases her spending before 1 January to reduce her retirement assets and receive a higher age pension. Barbara, though, she decides to save her money. The additional spending reduced Anne's final superannuation balance available on 1 January to $250,000. As depicted in the graph, although Anne's age pension is significantly higher than Barbara in the first few years, Barbara's age pension starts to catch up as her retirement assets reduce over time. However, by the time Anne and Barbara turn 84, Barbara's total incomes are well beyond Anne's, and by this time, Anne's retirement assets have exhausted. This effectively means that Anne must live on the age pension or use her home to generate income. Overall, it is not easy to formulate a perfect retirement savings plan, considering there are so many uncertainties involved. However, a key thing to remember is that short-term gain should never be the only reason to adopt a strategy. Pensions must take into account the long-term effect of their actions today on their capital and consider the retirement lifestyle they wish to maintain in the future. Thank you for joining our session today. Please contact our office if you wish to discuss your superannuation and retirement strategies. See you next time.